Right now, something is happening in the gold market that almost nobody is explaining correctly. In the last 30 days, $11 billion left gold ETFs in a single wave. Turkey liquidated 60 tons of bullion in 2 weeks. Gulf sovereign wealth funds are pulling physical gold out of London vaults at a rate not seen in 70 years. And gold, the asset that was supposed to go up during a war, fell 21% from its January peak. Every financial channel is asking the wrong question. They are asking, why is gold falling during a war? I want to ask a different question. I want to ask, what does this create? Because in 40 years of studying markets and debt cycles, I have learned that the most important wealth events in history don't look like opportunities when they happen. They look like crises. And right now, underneath this chaos, 3 completely separate wealth windows are opening at the same time. I have not seen this alignment since 1979. Stay with me. I'm going to show you exactly what I see. Here is what I want to explain to you in the next few minutes. First, I want to show you why gold's collapse is not what it appears to be, and why the mechanism behind it is actually the most bullish signal I have seen in years. Second, I want to show you a sector that almost no serious investor is talking about right now, but where institutional money is moving in a way that mirrors one of the most reliable energy patterns of the last 50 years. And third, I want to show you what I believe is the most structurally predictable wealth transfer in the history of the pharmaceutical industry, and why the clock on it is already running. These are not opinions, these are sequences. And understanding sequences is what separates investors who build real wealth from those who react to headlines. Let me tell you what is actually happening in gold. When markets face a simultaneous oil shock and a hawkish central bank response, something very specific occurs. Leveraged funds, the ones that run complex multi-asset strategies, get caught. They are long energy, short volatility. When oil spikes past $110 per barrel and the Federal Reserve signals it cannot cut rates because of inflation, those funds face margin calls. And when you face a margin call, you sell your best performing asset first. Gold had risen 65% in the 12 months prior to this sell-off. It was the most profitable position on most institutional books. So they sold it. Not because they stopped believing in it, because they had to. The data confirms this. BNP Paribas Commodities Research notes that in 2008, 2020, and 2022, the 3 previous major economic shock cycles, gold initially fell as investors sold their best-performing assets to raise cash. In all 3 cases, gold then recovered and made new highs once the forced selling was exhausted. Here is what I want you to understand. $11 billion left gold ETFs in March 2026. That is not retail investors selling. That is institutions meeting margin calls. The structural reason to own gold, de-dollarization, fiscal deficits, central bank diversification, has not changed. What changed is the technical picture. The price went down because of who was selling, not because of why gold exists. JP Morgan has maintained its year-end 2026 gold target at $6,300. Deutsche Bank is at $6,000. Neither bank has moved those targets. That gap between $4,300 today and $6,300 is not a prediction. It is a thesis about what happens when the forced selling stops. I have been studying debt cycles and geopolitical transitions for 4 decades, and when I look at what is happening now, I see a pattern that shows up, without fail, at major inflection points. The pattern is this. Moments of maximum confusion create the widest gap between price and value. Right now, that gap exists in 3 separate places, and the investors who understand the mechanism, not just the headline, will be positioned before the crowd catches on. Let me take you through each one. But first, if you find this kind of system-level analysis valuable, subscribe now. Subscribe now. Let me be precise about what forced selling means, because most people use the phrase without understanding the mechanics. When a hedge fund runs a leveraged portfolio, let us say they are 3-to-1 leveraged, and the value of their book drops by 33%, they are insolvent. The broker calls. They must raise cash immediately. They do not ask what is cheap. They ask, what can I sell quickly? The answer is always their most liquid, most profitable position. In March 2026, that position was gold. Turkey is a case study in what emergency liquidity looks like at the sovereign level. The Turkish lira hit its 11th consecutive record low against the dollar in the 16 trading days following the outbreak of the Iran conflict. The Central Bank of Turkey holds over 111 tons of gold at the Bank of England. Bloomberg reported they are considering borrowing against that bullion to defend the lira. In the meantime, they liquidated approximately 60 tons in the market. India became a net seller. Gulf sovereign wealth funds, ADIA, PIF, others whose actions are not disclosed publicly, showed up in the London bullion market data as a 45-ton outflow above the normal average. Here is what I want you to write down. These entities did not stop believing in gold. They needed dollars, emergency dollars, to pay for oil that now costs 40% more than it did 60 days ago. They are selling family silver to pay a temporary bill. And here is the mechanism that follows consistently in every cycle I have studied. When the emergency is over, when oil settles, when currency pressure eases, those same entities come back. They do not come back gently. They come back urgently, because their reserve diversification mandate requires it. The World Gold Council forecasts central banks will buy approximately 850 tons of gold in 2026, almost identical to last year's pace. The buyers did not leave. The sellers were temporary. Now, silver tells a different story, and in some ways a more interesting one. Silver has two demand sources that gold does not have: investment demand and industrial demand. In 2026, silver is now in its 5th consecutive year of industrial supply deficit. Solar panels, electric vehicles, AI data center infrastructure, each of these is an inelastic buyer of silver. They do not care about price. They need the metal to build the machines that the global economy requires. And yet silver is trading well below where industrial demand fundamentals suggest it should be. The gap between paper silver, futures contracts, ETF shares, allocated accounts, and physical silver has been one of the defining structural distortions of the past decade. I have watched it build. At some point, the gap closes. It always does. When it does, it closes fast. The structural bull case for both metals has not changed. What changed is the price. And price, in the short run, is set by the most desperate seller in the room. Right now, the most desperate sellers are selling. That window does not stay open indefinitely. This is the part of the analysis that surprises most people. And I understand why. Coal is not a word associated with opportunity. For the past decade, it has been associated with decline. Environmental mandates, ESG restrictions, pension fund divestments. Institutional capital has systematically avoided it. Coal mining companies have been starved of investment, and that is precisely why it is interesting to me now. Let me explain the mechanism. When Brent crude oil trades above $100 per barrel, it changes the economics of every alternative energy source on Earth. Power utilities do not make ideological decisions. They make arithmetic decisions. And when natural gas prices spike because LNG supply chains are disrupted, as they are now, with Qatar Energy having declared force majeure on long-term contracts following attacks on the Ras Laffan facility, utilities start looking for the cheapest available alternative. That alternative is coal. In Europe, it is currently cheaper to run coal-fired power plants than gas-fired plants. That is not a political statement. That is a price relationship. European utilities are rebuilding coal inventory for a burning season that may be longer and colder than forecasts suggested 3 months ago. In India, the data is even more structural. Energy Statistics India 2026, published by the Union Ministry of Statistics, shows coal supplying nearly 79% of domestic energy, even as solar and wind capacity expands rapidly. India's coal production reached over 1 billion tons in fiscal year 2024-25. Coal consumption is projected to grow by 2.5% in 2026. India's oil import dependence runs at nearly 89%, which means every oil price shock is an emergency for Indian energy planners. Their response, consistently, is to maximize domestic coal output. And in the United States, the current administration signed an executive order in April to reinvigorate domestic coal production, including environmental regulation waivers for existing coal plants. The effect has been an upward revision in U.S. coal demand forecasts for 2026. Here is what the investment picture looks like. A decade of ESG divestment has suppressed capital expenditure in coal mining globally. Supply has shrunk. Now demand is rising, not because the world changed its values, but because the world changed its energy prices. That combination, constrained supply meeting rising demand, is the setup that produces the most powerful commodity price moves. I am not suggesting this is a 50-year investment. I am suggesting it is a cycle. The cycle was created by capital avoidance. It will be resolved by capital return. And between those 2 points, there is a trade. Coking coal, the metallurgical coal used in steel production, has a separate demand driver that I find equally compelling. Every major defense spending surge in modern history has required steel. Ships, tanks, artillery systems, fortifications. The US, Europe, and their allies are all committing to multi-year defense spending increases right now. Coking coal forecasts from major banks project a price range of $215 to $222 per ton in 2026 and 2027. You cannot build a ship without steel. You cannot make steel without coking coal. That supply chain is not optional. The institutional money is already moving. Coal India, the state-owned enterprise that is one of the world's largest producers, is up 11.3% year-to-date in 2026, while the broader Nifty 50 index is down 6%. That divergence is not noise. That is money rotating into a sector that most investors were told to avoid. I have seen this kind of setup before. In 1999, technology was the consensus growth trade. Energy was the consensus avoid. By 2005, energy had outperformed technology by an order of magnitude. The mechanism is not identical today, but the structure rhymes. Consensus avoidance creates supply deficits. Supply deficits create price spikes. Price spikes create profits for those who positioned early. The third window is the one I find most structurally predictable. And by predictable, I mean something specific. I mean that the events driving it are already scheduled. The dates are known. The revenue numbers are published in annual reports. Here is the situation. The global pharmaceutical industry faces the loss of patent protection on approximately $300 billion in annual drug revenue by 2030. This is not speculation. It is a list of drugs with known expiration dates. Keytruda, Merck's cancer immunotherapy, generated $29.5 billion in 2024 and is projected to peak at $32 billion in 2026. Its core patent expires in 2028. When a biologic loses patent protection and biosimilar competition enters, revenue can drop 80%. Eliquis, the blood thinner co-marketed by Bristol Myers Squibb and Pfizer, loses U.S. patent protection in 2028. It generated $13.3 billion in combined sales. BMS faces the steepest proportional cliff of any major pharmaceutical company, with 47% of its revenues at risk by 2030. Ozempic and Wegovy, Novo Nordisk's semaglutide franchise, generated a combined $26 billion in 2024. International patents expire in Canada, India, Brazil, and China in 2026. These companies know this. Their boards know this. Their investment bankers know this. And they have one primary response: acquire. Pharma companies cannot build a new blockbuster drug in 2 years. Internal development takes 10 to 15 years on average and costs approximately $2.2 billion per asset. They do not have that time, so they buy what exists. Stifel Securities estimates the combined M&A firepower of major pharmaceutical companies at $1.2 trillion. Total pharma M&A deal value reached $240 billion in 2025, an 81% year-over-year increase. In the first 2 weeks of January 2026 alone, $9.2 billion in deals were announced. LEK Consulting projects more than 20 acquisitions over $1 billion in 2026 alone. Here is the investment mechanism I want you to understand. Big pharmaceutical companies are searching for small biotech companies with promising drug candidates in development. When they find one and acquire it, they typically pay a significant premium to the market price, 30, 50, sometimes 100% above where the stock was trading. If you are invested in the right biotech company before that acquisition happens, you capture that premium. The question is not whether this will happen. The deals are already being announced. The question is whether you understand the pattern well enough to position in advance. I want to be clear about the risk profile. Biotech carries a high failure rate. Clinical trials fail. FDA approvals are delayed. Individual companies can go to zero. This is not a sector for concentrated bets. The appropriate exposure, if any, is diversified. Broad-based biotech ETFs like XBI or IBB, which give you access to hundreds of companies simultaneously, or the larger integrated pharmaceutical companies that are already navigating the patent cliff through acquisitions and reformulations. What I find most important about this moment is the combination of factors arriving simultaneously. The patent cliff creates a buyer with a $1.2 trillion checkbook and a deadline. AI drug discovery is compressing development timelines. What once required a decade may now take 3 years. And the biotech sector itself, having bottomed in spring 2025, has recovered 75% and is now providing the valuation environment where sellers and buyers can agree on price. The wealth transfer from big pharmaceutical balance sheets to biotech shareholders is already in motion. The acceleration is scheduled. The dates are in the annual reports. Let me bring these 3 windows together and tell you what I actually believe. The gold and silver sell-off is a forced liquidation event, not a fundamental change. The structural buyers, central banks, long-term investors, de-dollarization practitioners, are still present. The price has separated from the value. That separation will close. It has closed in every prior cycle. The energy shift toward coal is a consequence of supply starvation meeting demand recovery. It is not a permanent reversal of the energy transition. It is a cycle within a trend. And cycles, properly understood, produce returns. The biotech patent cliff is the most structurally mechanical opportunity I have seen in any sector in a decade. The demand for acquisitions is quantified. The supply of acquirers is identified. The timeline is published. The only variable is which specific companies get acquired at what price. What unites all 3 is a concept I have returned to throughout my career: the difference between price and value. Price is what the market assigns right now, in this moment, under these conditions: forced sellers, panic, margin calls, oil shocks. Value is what a thing is worth when the conditions normalize. The gap between price and value is where wealth is created. It is not comfortable. It never is. The moments when price and value are most separated are always the moments that feel most dangerous. In 1979, gold fell sharply as the Federal Reserve under Volcker raised rates aggressively to fight inflation driven by an oil shock. Most investors sold. Those who held, or bought, saw gold rise more than 200% in the following 3 years. I am not predicting an identical outcome. I am identifying an identical mechanism. When you understand the mechanism, you do not need to predict the outcome. You need to understand the sequence. And right now the sequence is forced selling, exhaustion, structural buyers return, price recovers toward value. The three windows I described tonight are open. They will not remain open indefinitely. The investors who understand what is driving them, not just the headlines but the mechanics, are the ones who act before the crowd catches on. Let me close with where the numbers stand today. Gold, trading at approximately $4,300, down 21% from January's $5,596 peak. JP Morgan year-end target, $6,300. Deutsche Bank year-end target, $6,000. That implies 46 to 67% upside from current levels, assuming the structural thesis holds. Silver, fifth consecutive year of industrial supply deficit. Paper-to-physical ratio extended. Price recovery historically follows gold's recovery with amplified magnitude. Coal, India coal up 11.3% year-to-date against a declining broader market. Coking coal price forecast $215–222 per ton through 2027. Defense steel demand structural and multi-year. Biotech, $1.2 trillion in pharma M&A firepower. 20-plus acquisitions over $1 billion projected in 2026. $300 billion in patent-exposed revenue by 2030. The clock on this wealth transfer is running. These are not recommendations. These are data points. What you do with them depends on your own financial situation, your time horizon, your risk tolerance, and your judgment. But the data is what it is. I want to leave you with one final thought. In every major cycle I have studied, there are two types of investors at the inflection point. The first type looks at the price falling and concludes the thesis has changed. They sell or they stay out. They wait for certainty before acting. By the time certainty arrives, the price has already moved. The second type asks a different question. They ask, why is the price falling? And then they determine whether the answer reflects a change in value or a change in who is selling and why. Right now, the answer to that question is forced selling, emergency liquidity, margin calls, countries paying oil bills with gold they would rather keep. The value of the underlying assets has not changed. The investor who understands that difference has an advantage that does not last long. Markets are efficient in the long run. They are inefficient in the short run, precisely in these moments of maximum confusion. This is one of those moments. Three windows. 1. Gold and silver, where the gap between price and value is the widest it has been in this cycle, created by forced liquidation that has nothing to do with the structural reasons to own them. 2. Coal, where a decade of ESG-driven supply starvation is meeting a demand recovery driven by the most significant energy shock in a generation. 3. Biotech, where $1.2 trillion in pharmaceutical purchasing power is chasing a pipeline problem that cannot be solved internally, and where the timeline is written in patent expiration tables that every major pharma board has seen. I have spent 40 years watching these cycles. The windows that look most like danger are often the ones that create the most enduring wealth. The sequence is in motion. Whether you act on it and how, that is your decision to make.